Hey everybody, this is Ryan from Brass Tax Presentations. I hope you're all having a wonderful day. I wanted to take some time to talk about the new vehicle loan interest deduction or the car loan interest deduction, whatever you want to call it, that came out of the One Big Beautiful Bill Act. Now, we've been doing a whole series of seminars talking about the One Big Beautiful Bill Act. If you want to learn about everything from the bill in all of its complexity, join us for our Update for 2025 Return seminar. We'll talk to you more about that a little bit later. So the principal idea behind the vehicle loan interest deduction is that vehicle loan interest on a personal use vehicle historically has been considered personal loan interest, which has not been deductible in a very, very long time. So what they've done here is they've removed vehicle loan interest on a personal vehicle from the definition of personal loan interest in the code. And so now we've got this deduction that can appear for 2025 all the way through 2028, provided you meet certain parameters. So the first parameter is that it's got to be a vehicle with final assembly in the United States. So previously with something like the clean vehicle credit, you had to have final assembly in North America, which could have included Canada or Mexico. They've removed that. So it's just got to be within the US. Now, how are you going to know if a vehicle has final assembly in the US? There are VIN decoders that you can use that are offered by the federal government. I have two of them listed in the article on the website that's related to the vehicle loan interest deduction. So you can take a look at that down in the description below, or if you're on our website, you're already looking at it, scroll down a little bit, you'll be able to find those. And so that'll tell you, hey, if this vehicle had its final assembly in the US, then it could be an eligible vehicle. Original use must begin with the taxpayer, meaning typically that it has to be a brand new vehicle. Now, sometimes when they write original use in the code, the IRS later comes out, they redefine what that means. And so we may see an example or a time in which the vehicle doesn't have to be brand spanking new in order to be eligible. But generally, we believe that it's got to be a new vehicle as of right now. So it's got to be a new vehicle, but it doesn't have to have been purchased in 2025 through 2028. It could have been purchased before 2025, but in order for the interest on the vehicle to be deductible in that instance, you would have to refinance the loan in 2025 through 2028. And if you did the refinance, the deductible amount would only be on the amount that you refinance. So if you had a $20,000 remaining balance on that vehicle loan and you refinance it in 2025 or 2026 for a higher amount, like $30,000, which I doubt you're going to see, but it is possible, then you would only be able to deduct the interest allocable to the $20,000 of refinance debt and not the $30,000 that you now have as debt on that vehicle. So just something to be considerate of. They do mention that in the code. So it is nice to know that, hey, if I bought this vehicle before 2025, it is possible for the interest to still be deductible. It's got to be on a purchase. So if you have a leased vehicle, I'm sorry, that doesn't qualify. And if you have a relative who loaned you the funds to buy the vehicle and you are paying the relative back, again, that interest will not be deductible because it is being paid to a related party. So all things that we need to be thinking about. It has to be a vehicle under Title II of the Clean Air Act. Now, sometimes that freaks people out. It makes them think, oh no, this has got to be a clean vehicle. It does not. It could be the dirtiest vehicle that you can buy as long as it's made by a major manufacturer. So that could include any of the manufacturers out there, the major ones. So Hyundai, Toyota, Ford, GMC, could be, Mazda, any of those manufacturers. Could be the higher end manufacturers, your BMW, Audi, Mercedes. It could also be like the super high tier manufacturers like Bentley and Rolls-Royce. All of those vehicles can be eligible for this credit, provided you meet the other requirements that we'll talk about later with respect to the income phase out, because it will start to phase out for taxpayers with moderate income. So something to be considerate of, right? It's got to be a vehicle that was designed for use on public roads, highways, or streets. So it can't be a vehicle that you cannot take out on public roads, streets, and highways. something to be considered of. It can be a motorcycle, so if it's got two wheels, that's totally fine. Could also be a minivan, a truck, a sedan, yada, yada, yada. And it also has to weigh less than 14,000 pounds. But most people aren't going to buy a vehicle that weighs more than 14,000 pounds if they're going to have it for personal use. And again, if it's going to be for business use, then you're already getting a deduction for it. So you don't have to worry about this new car loan interest deduction for personal use vehicles. Let's talk about that income phase out that happens and the maximum amount of the deduction that we can claim. So our deduction will start to be phased out as the taxpayer's modified adjusted gross income goes over $100,000 or $200,000 if they are married filing a joint return. Modified adjusted gross income is simply the taxpayer's AGI plus any excluded foreign income. Most people don't have excluded foreign income, so it's really just going to be, in most cases, the AGI of the taxpayer. So for every $1,000 you go over those threshold amounts, you lose $200 on the deduction. Once you've applied that phase-out threshold, then you have to apply a $10,000 cap. That's the absolute most interest that you can deduct on a return. Now, some people are thinking like, well, how many people are really going to pay more than $10,000 on vehicle loan interest during the year if their income really needs to be less than $100,000 in order to be able to get full benefit from the deduction? And the thing that I would remind you of is that a lot of Americans have really bad credit, right? And so it's not uncommon to see a 10% interest vehicle loan or a 15% interest vehicle loan, or sometimes even higher, right? These loans can be very predatory. So it's just something that you may need to be aware of. Hey, my client who's making 50 grand might have, or 75 or 100 grand might have $10,000 or more of vehicle loan insurance, especially if you've got two brand new vehicles that the taxpayer has bought. Again, we live in America. People like to drive fancy cars. I like to drive fancy cars. I totally get it. So we apply our phase out first, then we apply our $10,000 threshold, and then we get the deduction on the return. Now, this car loan interest deduction was one of kind of like the four horsemen deductions. That's how I like to refer to them. Where we had the qualified tips deduction, the overtime deduction, and the senior deduction. In order to be able to claim those first three deductions, if you were married, you had to file a joint tax return to be eligible, or you had to be considered unmarried under the code. Not going to go into all that fancy detail here. But the nice thing about the car loan interest deduction is that you can actually claim it on a married filing separate return. So this is another case where Congress has instituted a deduction or a credit where there's effectively a marriage penalty, because if I'm single, I'm limited to $10K on my vehicle loan interest deduction. And if I'm married, I'm also limited to $10K, right? But the workaround here is that if I can file a separate return and we have enough vehicle loan interest, then each of the taxpayers in that marriage, the taxpayer and their spouse on their separate returns, could deduct up to $10,000 of vehicle loan interest on the return. Now, married filing separate comes with a ton of other considerations, right? There are certain deductions and credits that married filing separate taxpayers are not allowed to apply. So you need to kind of weigh, hey, is the benefit of both taxpayers getting a $10,000 limit more than the stuff they lose from married filing separate? For some taxpayers, that's going to make zero difference on all those other items, and so they get a benefit out of married filing separate. And for others, they might have, child tax credit or other deductions that they're looking to get that they're just going to lose out on. So, something you want to be thinking about. The car loan interest deduction, it happens after AGI is calculated, but before taxable income is calculated. So it finds itself in the same place as QBI, the tips deduction, the overtime deduction, all that fun stuff. It'll actually land on Schedule 1A of the tax return, brand new schedule for the 2025 taxable year, which again, we'll be looking at in the update for 2025 returns class. So I hope this video kind of helped you to understand how the vehicle loan interest deduction is going to work. If you've got any questions, pop them down in the comments or go ahead and shoot us over an email or come to our update for 2025 return seminar. Again, that's happening at like 18 different locations from San Diego all the way up to Redding in the state of California. And then we've got 2 sessions out in Nevada, one in Reno and one in Vegas. And we look forward to seeing all of you there.